Finance Fundamentals Part 1. Financial Statements. Introduction. Finance pervades all aspects of one's life, irrespective of one's age, though the extent to which one needs to be aware of it varies. Therefore, whether you are an aspiring manager, or an entrepreneur, or even a student, you need to be aware of some of the fundamentals of finance. Through this presentation, I shall take you through some of the basic financial concepts. Financial statements. A financial statement is a formal record of the financial activities of an entity, say a company or a person. The financial statements are framed based on generally accepted accounting principles or GAAP, and hence are similar and can be used to compare and contrast the performance of two companies or businesses. The four financial statements are income statement, balance sheet, cash flow statement, owner's equity statement. Income statement. The income statement is also referred to as a profit and loss statement or a P&L. Hence, it reports on a company's income, expenses, and profits over a period of time. It also helps in understanding a company's profitability and profit margins. Some of the common terms which are used in an income statement are the following: cost of goods sold, operating expenses, depreciation, interest expense, income tax. It will be useful to understand the meaning of these terms if we are to understand an income statement. Cost of goods sold. It is a manufacturing cost including raw materials and direct labor costs. Operating expenses. They include the administrative employee salaries, rents, sales, advertising, and marketing costs. It also includes all the other indirect costs. Depreciation. It is the diminishing value of equipment as time goes by. It is applicable to machinery, to buildings, etc. Interest expense. It is the interest charged on loans a company takes. Income tax. It is levied by the government on corporate income. Let us now look at a simplified example of an income statement and try to understand the various components and their interrelations. As point 3, we have the total sales revenue. The total sales revenue comprises of retail sales and corporate sales. So, we have the total sales revenue as 50,000 plus 40,000 equal to 90,000. The cost of goods sold is rupees 45,000. In order to get the gross profit, we deduct the cost of goods sold from the total sales revenue. A company incurs operating expenses and depreciation expenses. In order to get the earnings before interest and taxes, which is also known as EBIT, we deduct the operating expenses and depreciation expenses from the gross profit. So we have the EBIT as 45,000 minus 15,000 equal to 30,000. If we deduct the interest expenses and income taxes from EBIT, we get the net income. And so, we have the net income as rupees 20,000. Let's next look at the second type of financial statement, which is the balance sheet. In a statement, the balance sheet can be said to be a snapshot of a company's financial position at a given point in time. It uses the double entry accounting system. It is based on the simple equation assets minus liabilities is equal to the owner's equity. What are assets? Assets include a company's investments like land, buildings, machinery, etc. What are liabilities? The liabilities are the debts or borrowings of the company. Let us see how this equation can be used. If the assets is equal to rupees 60,000 and liabilities equal to rupees 45,000, in order to find the owner's equity, we deduct the liabilities from the assets. So we have 60,000 minus 45,000 equal to 15,000 as the owner's equity. As you remember, the third type of financial statements are the cash flow statements. What are the cash flow statements? A cash flow statement shows where the company's money comes from and where it goes. In other words, the flow of cash in, through and out of the company. For a given period, the cash flow statement provides the following information: sources of cash, uses of cash, change in cash balance. Let us now look at a simple example to appreciate the cash flow statement better. The net income is rupees 20,000. In the blocks in green, we have the sources of cash. These are the accounts receivable, inventory, and prepaid expenses. This together amounts to rupees 19,000. In the orange blocks, we have the uses of cash. These are the accounts payable, accrued expenses, income tax payable, depreciation expense. All this together amounts to rupees 12,000. And so, in order to find the increase in cash during a year, we deduct the various uses of cash from the various sources of cash. So we have the increase in cash or cash flow as rupees 7,000. We come to the last type of financial statements, which is the owner's equity statement. The equity statement explains the changes in retained earnings. It should show all changes in equity, including the total comprehensive income, owner's investments, dividends, owner's withdrawals of capital. I hope this presentation was useful to you in understanding the various financial statements. Thank you.